All right, welcome everybody. Thanks for joining us for investing in tax liens and tax deeds with your self-directed IRA or 401k. My name is Sean McKay, and this is an American IRA presentation where we're obviously doing a specific deep dive today in the self-directed topic into tax liens and tax deeds, which is becoming a more popular structure and strategy for our clients that want to be involved in real estate, but especially for those that maybe don't have multiple hundreds of thousands of dollars yet in their retirement accounts. This is kind of an interesting concept that you might want to kick around with your professionals, which certainly leads me to the first point about who we are and what our role is at American IRA. So we are the self-directed IRA or 401k provider for your IRAs and 401ks. We're not licensed, nor is any self-directed provider licensed to give tax or legal advice. And so we do ask that you always have conversations with your CPAs, with your attorneys in terms of structures and making sure that they're compliant so that you make sure that your retirement account can stay in good standing. And so we have a really interesting business model at American IRA. We're very similar to kind of the local bank, if you will, where we actually have real relationships with our clients. And it's a structure that kind of, to me, hits the ideal scenario on a number of fronts. So first and foremost is fees. A lot of people believe that our industry is kind of a commoditized service where it's all about just simply having the lowest fees. And so in response to that, we do have a very, very low fee schedule for our industry. So typically what you see in our industry is one of two models, either the old school advisory model, where they're going to charge you 1% to 2% of your portfolio on an annual basis, or they're charging you an annual fee per asset per year. And as you can see from this middle section, which outlines the American IRA fees, we're set up very differently than that. And so regardless of the size of the account or the number of assets, your baseline annual fee with us for the IRAs is $285 a year. So as you can see, as your account balance grows, as you accumulate more assets, that's just more and more savings to you as an investor. So it's very similar to the Vanguard model, what a lot of the online platforms have gone to on the equity side. The TD Ameritrades, the Schwabs, the Fidelities of the world, they understand that they need to really cut their fees down. And so we are definitely kind of the leader in having kind of a low cost for these self-directed accounts. Now, of course, everyone wants great fees, but they want great service, and as you should as a client. And so I can speak all day about how phenomenal our team is of taking care of our clients, but really I just encourage you to go online and not only look at our reviews, but look at reviews of competitors to see what the ratings are and the number of reviews that they have as well. So there might be some firms out there, especially in our region, that might have a pretty high review rating. So they might be close to us in terms of Google reviews, things like that from a rating standpoint. But then you look and you see that they only have 2 or 3 reviews. And so you don't necessarily feel like there's enough content there to make an informed decision about the quality of that service. So we're really proud of what our team does, especially on the operations end, which is kind of the heartbeat of our company. And we think that we provide a really high-end service, especially doing it at such a low cost. And so it's also important to note that when we talk about this idea of a self-directed retirement account, really the only thing that's changing with your retirement account are the investments that you can make with these accounts. And so really any retirement account can potentially be self-directed. So the IRA end, that's very straightforward. So whether you have a Roth, a traditional, a SEP, or a simple IRA, you can always move all or even just a portion of those IRAs over to us and quote unquote self-direct them. If you have an old employer-sponsored plan, like a 401k, a 403b, or a thrift savings plan, those can also be self-directed as well. If the retirement account is with your current employer, you normally need to ask someone in the human resources department or someone administering the plan to see if you have any ability to roll over funds to another firm or to do an in-service distribution. You also see that we have accounts such as Coverdale educational accounts, health savings accounts. Unfortunately, we do see inherited retirement accounts where the original account holder has passed away. And then the account is essentially then gifted to typically other family members. And so there's a lot of different directions we can go in terms of the types of accounts, but also in terms of the utilization of these retirement accounts as well. And so really the way the IRS code is written is it tells us what we cannot invest in with our IRAs and with our 401ks. And so really the sky is almost the limit in terms of structuring that we see. I was just on a call a few minutes ago with a consultant for private equity companies and doing purchase and sale of privately held businesses. And this is a unique concept even for that very sophisticated financial services provider, because this is unfortunately not something that's talked about very regularly. But there are so many different directions we can go with our IRAs and 401ks. And so the discussion, excuse me, that I have with our sales team often and our marketing team is that we're in kind of the awareness business. We're just simply trying to make the general public aware of everything that they can do with their IRAs and 401ks. And the thought is that once the investor is aware of what can be done, then they can make the most informed decision and presumably get the best results because they have a lot more quality information as to what options they have for investment. So as we look at the real estate asset class, any type of physical real estate can be acquired with these IRAs and 401ks. So anything from raw land to condos, townhomes, single family homes, industrial buildings, commercial buildings, apartment complexes, you name it, these retirement accounts can directly own these assets. Now, many times with these larger assets, what we see is that there will be a group of investors that will get together to make that purchase of the 300 unit apartment complex, the $7 million, could be a $700 million retail shopping center. There's just a lot of different ways to deploy capital. And so these retirement accounts can be a member of a multi-member LLC, but it can also be the sole member of an LLC. You may have heard about the term checkbook control with these retirement accounts, and that can be done with these accounts at American IRA. Now, as we mentioned earlier, certainly today, the focus is going to be on the tax lien and tax deed kind of subcategory of the real estate space. And so we'll dig into that. But again, as I mentioned, the private equity world, the privately held company world, that is certainly a growing element of the self-directed arena. And we're seeing more and more clients that are interested in investing in non-publicly traded companies, but companies maybe in their own backyard that they understand, that they get to actually have conversations with the founders of those companies. And so they just have a little bit more information to make, again, hopefully a more informed decision with their retirement accounts. And so as we look at this idea of purchasing tax liens, the basic premise is that, as many of you are aware, if you own a property, whether it's raw land, a single family house, or a commercial building, each year you're responsible for paying property taxes for the ownership of that real estate. And so if for whatever reason the owner is unable to pay the property taxes, the county or the local municipality, they need to have that revenue stream. And so they will essentially put a lien on that property and sell that lien off to the investment community, if you will, so that they can get their monies to keep all the services going in your local area. And that gives the opportunity to investors to potentially make a solid return on their investment dollar. What's interesting about these tax liens that are put on properties is that the lien is actually a superior lien to that of a mortgage. So the lien holder will actually get paid if things really go south and the property ends up being foreclosed on. The property tax lien holder will actually get paid before the mortgage holder, so the banks. And so again, this is just simply a way for the county to kind of keep their typical revenue streams going. Now, it's important to note that every state has very different rules around these tax liens, these tax deeds. And so it's critical to understand in your local market if this is a viable option. Because what I will tell you is actually both of our offices, Asheville, our headquarters, as well as our satellite in Charlotte, both located in North Carolina. North Carolina is one of the few states that actually does not auction off tax liens as most states do. So I would argue we're a little bit behind the curve. You can find properties where property taxes have not been paid for 10 plus years on the property. And so that's certainly lost revenue for the cities, for the counties, and perhaps something that will get shored up in the future. But anyways, all that to say, you need to understand your area, what is possible. So what you find is residents of North Carolina many times will look at either neighboring states such as South Carolina or Georgia. They might look on different state platforms that have online auctions. So it doesn't really matter where you physically live, you can invest in online auctions for states across the country and what have you. So again, every state is very, very different. So you need to understand the rules around kind of the area that you're wanting to invest. So why would someone want to buy a tax certificate? And so as I kind of alluded to at the beginning of this discussion here today, it is a way that investors can participate in the general realm of real estate investing, but do it in a way where they're not necessarily having to deploy as much capital. And so many investors will get frustrated with looking at the prices of properties, especially these days, and saying, I don't have the $200,000, $300,000, $400,000 in capital to be able to buy a rental property, for example. But if they have, let's say, a few $1,000s, they may be able to purchase tax liens in an area that they think is a kind of reasonable place to invest in tax liens. So with tax liens, really, the results are going to fall into one of two categories. So if you buy a tax certificate, you understand you're basically going to get one of two outcomes. The first is that the homeowner, or sometimes the bank that has a mortgage on the property, will catch the property up in terms of the delinquent taxes, as well as any penalties and interest that has accrued on this property. Because again, the bank doesn't want to lose their interest in the property, so sometimes they'll even pay that off, and of course pass that fee along to their borrowers. Or again, depending upon the state, your tax lien could actually transition into having the right to actually acquire the property via a tax deed auction. So after a certain period of time, in most states it's a few years, you're going to have the right to bid to actually buy the property outright via a tax deed. So really the two outcomes are we're either going to get paid our principal and interest, or we're going to have the opportunity to actually end up acquiring that property. So as we look at strategy number one, which is basically getting our principal and interest back, that is a strategy where you see the larger, usually kind of institutional money that is looking to be in this kind of space, where they are deploying millions and millions and millions of dollars of capital into these different auctions, and they're just simply hoping to get a decent return on their investment dollar. And so many times they're trying to target the higher quality, the higher end properties, with the assumption that their tax lien is attached to real estate that has some real value to it. Because the reality is that they're not able to do full research or due diligence on these properties that they're buying the tax liens for, because they're buying sometimes tens or hundreds of thousands of dollars, or tens or hundreds of tax liens each year. So they don't have the manpower to do all of the legwork on the due diligence there. So they're looking usually at states that have online auctions, because again, the theory is they need to be as efficient as they possibly can with these vehicles. And so online auctions in states like Florida, Georgia, Texas, those are places where you can deploy a lot more capital, a lot more efficiently with these online auctions. So that's kind of one way to look at it. The other idea is actually trying to end up accumulating properties via the tax lien and what becomes a tax deed auction. And so this is a strategy where the investors understand this is really kind of a statistical odds type of scenario where you're probably not going to buy just simply one tax lien each year and then have that owner of the property default and you have the ability to acquire that property. Sometimes investors will have to buy hundreds of tax liens in order to come up with that one property that they can actually gain ownership of. And so with this scenario, again, this is the other end of the spectrum. Typically, you're not going to end up foreclosing on the $5 million retail shopping center or apartment complex. Usually there's a bank or somebody that's going to get that property caught up on their delinquent taxes. But I'm sure it's happened from time to time. And so this is a strategy usually where you want to deal with properties that do not have a mortgage on the property. So it's free and clear, no mortgage, so you don't have to worry about a bank swooping in and getting the property caught up. So many times what you'll see is investors want to go to in-person auctions. So an online auction, really anybody can see these properties and can invest in these. And so ultimately, if you go to an in-person auction, your competition to some degree are the individuals in the room. What I will tell you is that in today's world and kind of the scenario where institutional money is working so hard to get a decent yield, you will see institutional investors that will send a representative to these in-person auctions, which can make it challenging to compete with institutional money. So just a little bit of food for thought there. And so as we look at the strategies associated with tax liens, typically what you're going to find is that with these auctions, you're going to fall into usually option one or option two. So option one is where the retirement account is going to be the sole owner of the tax lien, and it's going to pay cash for that tax lien. Option number two is where the retirement account will actually partner or joint venture either with one or multiple investors, and that group of investors will then go and again, usually pay cash for the tax liens that they're acquiring. There are certain circumstances where retirement accounts can actually borrow money in an effort to be able to go and buy tax liens. Usually you have to be a very large player in the space. That's a very, very complicated transaction. You're certainly not going to your typical retail bank and getting a loan so that you can buy tax liens with your retirement accounts. The type of debt is very specific. It needs to be a non-recourse debt in terms of being able to properly collateralize the borrowed money against tax liens is also a pretty complicated transaction for many of us. So again, option three is very atypical for tax lien investors. And so when you think about this from a very big picture standpoint, please keep in mind that the retirement account is actually going to be the owner of the tax lien. So the retirement account will use its capital to buy these tax liens. And so any sort of income derived from the interest, or perhaps if the property ends up being acquired by the retirement account, any sort of rental income or income from the sale of that property will flow back to the retirement account, because again, the retirement account is the owner of the asset. So it pays any and all expenses and it receives any and all benefit associated with this investment. And so in order to be successful with this strategy, you must do things in the correct order. And so the first step will always be to open and fund your self-directed account. So with a firm like American IRA, for example, The next phase is to go out there, do your research, do your due diligence on the areas. And then once you've identified the area, the specific properties that you want your retirement account to purchase a tax lien on. Ultimately, you'll give us directions to send monies either to a municipality on behalf of your retirement account for the purchase of the tax liens, or you might elect to utilize an entity structure. So the retirement account will fund a kind of specially created IRA or 401k owned LLC. And then that LLC will then go on to essentially register with the municipality that is holding that tax lien auction, or the third party group that is doing the online auction for the tax liens. And then ultimately, again, your retirement account or your retirement account owned LLC will end up purchasing those tax liens. So really appreciate everyone's time today. Again, I'm Sean McKay with American IRA. My email is Sean, SEAN, at AmericanIRA.com. Our website is AmericanIRA.com, and our Asheville headquarters is 828-257-4949. So again, appreciate everyone's time today. Hope everyone's doing well, staying healthy, and hopefully we will see you at a future webinar.